the basics of inheritance tax. In this video, I'm going to look at what are the basic concepts of inheritance tax. I do regular videos on tax and accounting, so if you'd like to subscribe, you'd be very welcome. Pressing the like button really helps me and the channel. Thank you. So inheritance tax, well, what is it? So it is what it says on the packet, if you like. It's a tax, so it's not you do not get taxed as an individual on what you have. It's when you die, so you only pay it when you die, so you don't really pay it. It's your heirs that suffer the tax, not you yourself, because when you die, all your assets and liabilities are put into a big pot, and then it's a tax on that pot if it's over certain values. So it's a tax paid by your trustees after you've died based on what you leave. First of all, there are limits, and the limits are reasonably big, so it means that most estates do not pay inheritance tax. Because to start with, there's a £325,000 limit that each individual gets. So everybody gets £325,000 before they their estate pays any inheritance tax. So that actually excludes most people. If your spouse, and you're a proper married spouse, dies and leaves all of their estates to you, then you also inherit their inheritance tax band. So in that case, you don't have £325,000, you've got £650,000 as a married couple. So that means that really does cover most estates. But obviously a lot of people also have more than that. And there's a third part of the allowance, which is if your house, so if you leave your house, and it has to be your house left to your descendants, so not to your nieces or nephews or your friend. If you leave it to your children or your grandchildren, then you get £175,000 allowance for your house. So, and also that can be inherited if your spouse leaves all their stuff to you. So that adds up to another 350,000, which 350,000 plus the 650, which I already talked about, is exactly £1 million. The house, you just got to be careful with the house, because it only applies if you leave it to your descendants, as I've said. If your estate is worth more than £2 million, you don't get it. So if all your assets are worth more than £2 million, you don't get it. And if your house is worth 200,000, you wouldn't have the full £1 million. You'd have 200,000 plus the 650. So in that example, you'd have 850 before you pay inheritance tax. And equally, if you've got £500,000 house, then the first 350 you'd get your allowance for, and the remaining 150 you'd have to use your general allowance to cover that off. So it is a bit weird, but I think it's fairly straightforward. Basically, if your house is worth more than 350,000, you get £1 million if you leave your money to your direct descendants. So there are other ways that things that people talk about with inheritance tax. The big ones are businesses. So if you have a business and you leave the business to your heirs, or to, when you leave your business, then that is exempt from inheritance tax. So it counts towards the £2 million that I talked about before, that gets you your house, your allowance for your main house. But your business can be transferred to your children or whoever, free of inheritance tax. That also means you've just got to be a little bit careful if you sell your business, because when you sell your business, you're also creating at that moment an inheritance tax liability very often, because if you sell your business for £1 million, you then suddenly, your heirs would have a big inheritance tax bill to pay. So that's just worth thinking about if you are looking to sell your business. The other big exemptions are the 7-year rule. So if you make a gift, anybody can make a gift to anybody, and that doesn't trigger an inheritance tax bill. So you can give money to your children during your life. That doesn't create an inheritance tax bill. But if you die within 7 years, then in those cases, then it then counts towards inheritance tax in a slightly peculiar way. But as long as you survive 7 years, then the gifts are free of inheritance tax. But if you don't, then it is included. So that's why they're called potentially exempt transfers, or PETs. So it's a potentially exempt transfer because it's potentially, as long as you live, the potential being as long as you live for 7 years. Exempt means not subject, and it's a transfer. You've transferred wealth away. So that's the other main way in which people avoid having to pay the inheritance tax on their estates. I know that with inheritance tax, people have very different attitudes really to it. So some people say, well, my children do very well out of me, I can't, I'm not making adjustments to my wealth because it doesn't affect me, I'll already be dead, and I don't care that they have to pay the tax. And for other people, they think, no, this is a very high tax because the tax rate is 40%. So once you've gone over the limit, then you're paying 40%. So if you've got the £1 million limit and you leave another £1 million, then you're paying £400,000 in tax. So it really kicks in quite hard. And for a lot of people, they feel that they built up and paid tax on their assets as they built them up. They feel they paid a lot of tax over the years, and they don't want the assets that they've spent their life creating to be just given to the government. And maybe they don't even feel that the government spends it all that wisely. So therefore, that's why people look to some of these main inheritance tax sort of allowances and ways in which you can make sure that you don't pay it. I think a much overlooked allowance is the small gifts out of income. So if you've got income of say £50,000 a year, or you've got a reasonable income, then you can make gifts out of that income that doesn't really impact on your life as you go along. So you might give regular gifts to your family or to people you want to feel generous towards, and those don't get caught by the 7-year rule. They're simply out with your inheritance tax estate altogether. And I think they're quite often ignored. I think with inheritance tax as well, the other thing that's interesting is pensions. So pensions don't fall into your estate at all, because pensions are held in trust. So you don't fully own a pension scheme. It's owned by your trustees for your benefit. When it never touches your estate because you never owned it. So you can leave your pension assets out with your estate and your inheritance tax limit. So they can be a way of transferring wealth to the next generation. And it also means that when you take your tax-free lump sum, so if you were lucky enough to take £250,000 tax-free lump sum, and maybe it's a couple, even £500,000, £250,000, then that goes from being not inheritance taxable to being inheritance taxable. So that's, again, another consideration that it might be worth taking into account. So there we have it. Inheritance tax. It is it's taxed not on you but on your estate. So you won't be, any planning that you do, you won't be around to see the benefit, but your heirs might be very appreciative. And as I say, for some people it's really important, for other people they don't consider it to be important. But I think the key fact is that with planning and forethought, there are some major ways in which you can not pay the tax. And the other thing is that at 40%, you don't pay it on a big amount of money, but then at 40%, it kicks in hard. And I think that, you know, if you've got a property portfolio, you might have to remortgage, or you might have to sell some of the properties if you die unexpectedly, or you haven't made planning beforehand. So I hope that helps. If you need any other thoughts, you want to talk to us about the thoughts you have on inheritance, then please let me know. I do regular videos on tax and accounting issues, so if you'd like to be kept up to date, please subscribe to the channel. If you press the like button, it helps me in the channel. Thank you.